Good afternoon and welcome to the latest Yellowstone Advisory webinar. Today's company presenting is DP Poland, who reported their half-year results on the 26th of September. I'm delighted to have with us today Nils Gornall, CEO, and Edward Kacyrz, CFO. And I'm now going to hand over to Nils to start today's presentation.
Thanks, Alex. Good afternoon, everybody, and thanks for your time. So I'm Nils Gornall. I'm CEO of DPP, who owns the Croatian and Polish business for Domino's Pizza. This is my 30th year in Domino's. I started at 15 years old in Australia. I was a franchisee by 22. 2018, moved to Croatia, and I started the Croatian business, which has been highly successful. And then last July, I moved to Warsaw, and I've been living in Poland and running DPP ever since.
Hello, everyone. My name is Edward, and I'm the CFO of Domino's Poland for the last 7 months already on board. My whole career is in retail business, holding different positions from the financial controlling strategist and business development via the expansions to the new markets and development of the crucial projects for the previous companies. I had the pleasure to work for Mars, for Kimberly-Clark, Levi's, Smyk, and Velvet Car. Nils?
Okay, so 12 months into the turnaround. So I started basically 12 months ago in July last year. Look, it's been a really good year. The growth we've achieved has really turned this business around. We came here, we refreshed the management board, we refreshed the management team. Most importantly, we added global Domino's experience to our board. We're trying to emulate all the other successful Domino's brands around the world. And we needed the strategy sitting on our board as well. We looked at our portfolio. We said we're going to close some stores. We closed 10 loss-making stores, mainly in shopping centres and a few poor locations. We put capital investment into existing stores to maximise our productivity. And we saw sales increasing. We saw our delivery times coming down in these stores, and most importantly, our labour coming down in these stores. We focused on increasing the customer value proposition through implementing our high volume mentality, fast delivery, compelling pricing, and high quality pizza. For the next 12 months, we'll continue working on growing our average weekly order count, as this is key to increasing profitability. Continued improvement in customer retention numbers through operational excellence and a few tweaks in our IT system. Further reduction in delivery times, and most importantly, growth in profitability to drive compelling franchise proposition. So, as I said, it's been a big year. Group revenue up 26.5% on the same period last year. 5% of that is from the Croatian purchase. 21% is from Poland. So, let's not forget we did close 10 stores. We opened 2 last year, so a net effect of -8 stores, and we've still got that over 20% growth. So, rather proud of that number. Like-for-like sales as well, very strong, 17.7% on the same period as the year before. So, in this type of environment, we're really quite proud of this number. Over 11% was in customer count growth. So, it wasn't just in price. We were very smart with our pricing and discounting strategy, and we continued to bring in new customers into the system. Our average weekly order count, we call that AWOC. So we hit 700, average of 700 for the Q1, up 14% year on year. And then group EBITDA to 1.1 million, up a massive 171% on the year before, and we're just getting started.
Quick look into the P&L, gentlemen, gives us a very good perspective for the coming months and year. Nils mentioned about the sales and revenue, which went up more than 20%. What is crucial definitely for us is the structure of this increase. More than 60% of this growth is driven by the order count, which means that we bring additional consumers to our network. What is also very important is the spread of this growth between different channels. Both delivery and non-delivery channels grew more than 15%, and non-delivery channel grew a bit faster than the delivery because it held less portion of the business, and we focus over the last 12 months very strongly on carry-out business development, which in the inflationary world gives much more value to the consumers. All the numbers that we present are supported by the Net Promoter Score that grew by more than 50% in new and returning customers. We see that they are happy with the changes that are happening in our business, and we want to follow that path. Concerning the direct costs, we see a growth in this line. Definitely, it's driven by the additional order count that we generated over the 12 months. What is important, the pace of the growth is much slower than the top line, which is exactly what we wanted to achieve. And this automatically goes to the bottom line and improves our EBITDA. Direct cost had a set of negative impacts over the last 12 months. That was the energy, labor, and food cost prices that we had to handle with. We, of course, taken the actions to mitigate all those impacts. The first one regarding the labor system, regarding the labor, we introduced the Tanda labor system, scheduling system that allowed us for better control over the hours worked by our employees. And with this tool, we were able to reduce our labor cost by about 5 to 6 percentage points of the net revenue. With regard to the energy prices, we use the governmental subsidy program that allows for the freeze on the energy prices for medium and small companies to which we allocate to. So from that perspective, that also gave us a control over this line. And food costs, which are part outside of our control. Winter was very negatively impacted because that was the first winter after the Ukraine war has started. But at the same time, we did lots of improvements around our pricing strategy and portfolio mix, so that we did not just increase the prices on the nominal value, but we introduced some of the portfolio that let us keep the entry prices for the consumers, keep the traffic towards our business, and then migrate or upgrade the consumers to higher quality products and to the superior products, by that increasing the average ticket value. SG&As, this is a line that visibly differs from last year, but the main reason for that is the TV campaign that took place in Q1 2023. That was the TV campaign held for the first time in 5 years history. And we got a very positive returns and feedbacks after the post-campaign surveys. We believe that this mean of communications will be used in the future. However, for coming autumn, we will concentrate on digital, where most of our target group is visible, and we believe that we can achieve the same result much more efficiently on the cost side. All in all, it transfers all these activities and those market conditions impacted our EBITDA. EBITDA grew by £700,000 versus H1 2022, which is 170% up. And this is what we wanted to achieve. The difference between last year and this year EBITDA goes almost directly to the loss for the period. We are still negative on this line. However, the trajectory and the growth is visible, and we believe that in the coming months and years, we'll be able to stay on the same trajectory. Nils?
Okay, so strategy for growth. So like I said, when I started here over a year ago, our sales were simply too low. You know, we had no choice but to grow ourselves rich and grow ourselves out of this problem. So we went back to the basics. We improved our pizza quality. We upped the spec. We started delivering faster. You know, we're now 7 to 8 minutes faster to the customer. You know, it's a third third quicker that they're receiving their order. And we became really smart and competitive on our pricing strategy and discounting strategy. So in turn, this really started to help improve our customer retention. This is key. This is key to raising volumes. Generally, overall, the customer was just getting a better experience. They were coming back, frequency was increasing, and we're just getting more loyal customers. So this turned into higher average weekly order counts. And what we'll show later on in this presentation, now we've reached into profitability now that the inflation numbers have cooled off. So we've hit our first target of weekly order counts. We have lots more to come, lots more growth to come in our existing stores, but we're already seeing that profitability already come through. Expanding franchisees, so profitable stores are essential for successful franchising. So, this is where the stage we're at now. We want to make sure that we get all of our stores to that profitable stage. Then we can start selling down our stores, and converting our corporate stores to franchisees will, provide growth, and will also provide the medium-term capital for future growth as well. So this slide here is just sort of showing the progress we've made with our average delivery time. So we're in the low 30s. We brought that down to the mid 20s, and you can see at the same time on the right hand side, our order counts just continue to grow. So what we're finding is that the better we can handle the rush over here, the more sales increase. The biggest question I had when I first arrived, with the poor history of DPP, was how do you know the Polish are going to eat pizza? So look, I think we've proved that. I think the problem was in our own house. Personally, I've been working with Domino's for 30 years, so I know when you get this right, when you get the system right, it's a great business. It's the best franchise system in the world, and we just had it wrong here. So we've come along, like I said before, we've decreased delivery times, we've done all these things, and look at the results. So our focus on times in our stores has definitely increased our customer satisfaction. It's increased repeat business, and in turn, we're just getting more and more loyal customers, and sales are just on the up. Okay, next slide. So a few things we just sort of wanted to share that we're proud of. The mobile app this is a big thing for us. We really try to push our customers to jump onto our app. In the past, our app wasn't good enough, so we spent some capex late last year and improved the app. We relaunched that in January this year, so it's less clicks, it's easy to use, it's easy to make payments on it, and the overall feel is just better. So improvements are massive. We're now 89% of our delivery orders are online. And this is something that we're really trying to grow. We want to have this app in people's pockets. It gives us customer loyalty, and it really reduces our conversion costs. Net Promoter Score. Look, this is one we're really quite proud of. So new and existing customers, over 60% growth. So it's certainly big numbers. And it just goes to show, with the better pizza quality, the faster deliveries, we're getting that response from the customers. We're finally being recognised in the market. Customer base is continuing to grow. So we've now hit 64% of our customer base is returning and regular customers. So we're growing that base, and overall order counts are up 14% year on year.
Yeah. So. Just to give you a bit different perspective to what we say, because we constantly focus on average delivery times and average weekly order counts. And we believe that there are these are two parameters that has a vital and dominant role for the EBITDA and performance of the stores. And these slides show you how the development of the store structure goes over the last year when Nils came here, and where we are after 12 months, the same period. Yes, so in 2022 we had on average 580 average weekly orders. and H1 2023, we end up almost with 700 orders, which means that we added 110 orders to every single stores on average on a weekly basis. And we also changed the structure of our stores with all those activities that we mentioned before. We added 15 percentage points to the stores doing 750 orders and plus, and we reduced the number of stores being below 650 orders. What does it mean for the business? Whenever we move with the average order count up, we also improve the store EBITDA. And this is very visible on the right-hand side, where you can see that on average, our EBITDA grew by 4 percentage points, and it became positive for the business. And at the same time, we doubled the number of the profitable stores, and break-even plus stores right now count for 80% of our portfolio. This is exactly what we wanted to do for the business, focusing on these two parameters, and we believe that they are crucial for the future development of the company. The same slide for Warsaw is right now presented to you. This is important because Warsaw is a market where we hold a dominant position. And you can see that being the first gives us the advantage of higher transformation of the business. With all the same activities for this market, we grew on average by 140 order counts on a weekly basis. And that translated to more than 5 percentage points on the EBITDA level. And here, more than half of our stores currently are profitable, whereas 85% are break-even plus. So out of those two slides, I believe it's fair to draw two conclusions. The first one, whenever we look for the KPIs that we believe are crucial for the company, definitely it will be AWOC and delivery times. And this will be our focus. The second conclusion is that whenever we are dominant in some region, then the activities that we implement to the market has much bigger effect and translate easily to the EBITDA. So we will be definitely focusing on gaining this dominant position in 5 cities, the biggest cities in Poland, as well as we will be looking into the increase of our white space via different, whether this will be organic or a franchise model, kickoff, or any other form of market consolidation. We want to grow the white space to hold the dominant position, not only in the one city, but in the whole Poland. Translating those two slides into the trend line, you can see that over an 18-month period, the EBITDA of the stores improved massively and is on the constant growing trajectory. January and February this year is a bit difficult moment because here we absorbed the biggest hit with regard to the labor price increases, with regard to the food costs and energy. But whenever we mitigated those parameters, we can see a massive improvement already in March. And definitely impact on the EBITDA of the stores had the improving top line with the growing order count and stable average ticket value. That translated to the EBITDA being positive from May onwards. And when you compare the period of 4 months, May to August 23 to May, August 22, you can realize how big a step change the organization did in a year time.
Yeah, so I'll just say a quick couple of words on this one. So I started in July. Our biggest focus has been on sales growth. So we've seen consistent sales growth throughout this period. Unfortunately, in the middle of this, we had inflation hit. So December, January, February seemed to be the peak of our inflation. Now we're seeing it drop off. Now the profits are coming back. Now the biggest win we've had is our labour costs. So we've been working on this the whole way through, the whole time I've been here. We did implement a big project, a scheduling project, which is implemented in every single store in the country. Now we're seeing the consistent labour coming through, and now that we're seeing our food back to normal levels, our sales are up 20% on the year before. Now we can see the profit. So hopefully we see this moving forward. But yeah. So next slide, just wanted to talk about market opportunity. So now that we can see that the Polish do eat pizza, and if Domino's gets it right, we can definitely increase our sales and our store count. So this is what we see for a 3 to 5 year picture. Poland's a big country. We've got 40 million plus people here. It's a booming economy and has been for a while now. We really feel it has potential for 500 plus stores. Medium-term target for us is 250. Our AWOC, the average weekly order count. So we've hit our first target, 700. We're not happy with that. We've got a long way to go. Our short-term goal is 900. We know we can beat that. I mean, where we get 900 from, we know the European markets. We know what we should be doing. So we're super confident we can get to this number. We already have 20% of our portfolio already over 900, and we're really confident that over the next couple of years we can move this number all the way to 900. Franchise stores. So at the moment, 7% of our portfolio is franchise stores. Year to date, franchisees are at 10% EBITDA. Year to date, August. Obviously, the franchisees had the same pressures that we had in Q1 with the high food costs. So their profits since then are looking very, very encouraging. So they're happy franchisees here in Poland. Group pre-IFRS. Look, our modelling showing as we grow our store count and our profitability is turned around, we should be making 10 to 13% is our target. Last page, and then we can open it up to questions. Look, in summary, our house is now in order, and we've made significant progress over the last 12 months. Improvements in delivery times and product quality are really driving customer satisfaction. Our high weekly order counts is now unlocking profitability. We're starting to see those stores hit 700, 750. We can really start to see the profits come in. And then improving store economics will start the franchisee rollout, provide the flywheel for growth. The franchise growth is where we want to be. We've really got to get this right. So it's a big project for us. We've got to put the right people in place, and we've got to make sure that it's successful. This will transition us into a capital light business, which is going to help fund our future organic growth. And then last point for me, the Polish market, it's huge, and it really has the potential for 500 plus Domino stores over time. And that's it from me, Alex. If we want to open up to questions, we're more than happy to answer any questions out there.
Brilliant. Thank you, Nils. Thank you, Edward. And I think firstly, many congratulations on the progress that you've made over the last year. It's clear to see you've come a long way since you joined 12 months ago. We're now
absolutely. I mean, we came and we said what we're going to do, and we've achieved that. So yeah, we're quite happy. That's the first year, and yeah, looking forward to the next one.
Perfect. Look, we are now going to take questions, and if you do want to ask a question, please could you type it into the Q&A box at the bottom of your screen, and we'll try and cover as many questions as we can. So just starting off on a question on pricing, how have you managed the pizza pricing during the year?
So we've done it a few ways. Obviously, we are not number one in Poland. So we're following the leaders. We've taken small amounts of price. Mainly for us, it is we're trying to increase our customer count. So we've stayed competitive on pricing. We've moved a lot of our business to carry out so that we can offer that cheaper pizza. When you get a delivery, there is that delivery fee involved inside that. So we've been very smart in trying to push value to customers on carry out, and allowing them to still indulge and enjoy as many pizzas as they can for a smaller price, and value is not also on price as well. Value is the overall package. So, the better your image, the better your pizza, your faster your delivery times, as well as your price is going to give value. So, I think we've sort of nailed all three on the head, and that's why we're having this growth.
Maybe one comment on that.
A couple of link questions to that, Nils. We're obviously all familiar with the price here in the UK, but can you give us an example of what the price of a pizza costs in Poland?
So for a carry-out, you can come in. We have entry price at £17.98. So in pounds,
£3.5.
Yep. So so we have different ranges. So you can have a one topping pizza for that price. For one of our top 10 pizzas is £21.95 slotties, which in pound is, Edward, you got that number off the top of your head? 4.3. So you can see our prices are very attractive. That's for carry out. For a delivery, we can deliver a pizza for 40, 45 slotties, depending on the size.
Yeah, which is around £8, more or less, 8 to 10 pounds.
I've got a question for you here, Edward. Is wage inflation a net positive for the pizza business in Poland? And given that costs are well managed, do you anticipate wage rises across the economy boosting sales?
It's a very good and very complex question, I would say, because the inflations and wage increase has two sides of the coin, are the same, two sides of the same coin to some extent. We are definitely in the restaurant business that we can treat as a mainstream. So definitely we are more dedicated or oriented into low and medium wage people. So automatically it means that whenever the wage goes up, we are potentially the beneficient of this kind of increase because more people can afford for this kind of leisure or food or kind of some kind of a delivered product from the restaurants. On the other hand, whenever we have a salary increase, it definitely affects the cost of labor, and that is necessary for the build for the preparation of the pizza, and impacts the prices that we offer to the consumers. So what we did and what we are going to do in the future is definitely to concentrate on proper scheduling of the labor costs so that we are more and more efficient on the production side. So then we will not be forced to transfer all the wage increases into the pizza costs, and automatically that should build us a competitive advantage versus the other players, especially those smaller ones that are less organized. They are not in the chained QSR industry, and they definitely will not be able to absorb such a cost or create the efficiency on the production side. So I believe all in all, although these are two sides of the coins, net effect should be positive for our business.
Okay, thanks, Edward. Nils, coming back to you on average order count, are stores profitable at 750 orders per week?
Look, obviously it's all averages. So the simple answer is yes. Obviously it depends on your rent. So you might have some that are in different areas with a higher rent, and so their break even might be above 750. You also might have some stores in areas of Poland where the rent is not as expensive as Warsaw, and you'll actually be under 700. So, but yes, simple answer is yes.
Okay, and then just to follow up, Nils, on that same point about orders, you had 900 orders as a sort of a target on one of your slides, and it's 900 orders per week, the sort of the top end of what is achievable, or is that just a short-term target?
Definitely short-term target. I mean, we should be well over 1,000. That's what other markets are. That's what Croatia is. They're well over 1,000 as well. So 900 is a target that we really feel that we can hit in 2 to 3 years.
Perfect, thank you. Edward, a question here for you, I think. How many franchise stores do you have versus corporate stores?
Right now, we are running 7% of our portfolio as a franchisee stores. This is altogether 8 stores held by 3 franchisees. The total number of stores at the end of the year will be 112, which means that 104 will be corporate stores. This is the structure that definitely requires a change. We keep this structure for a very good reason. First, we want to make the stores profitable so that the value of the stores will be based on EBITDA multiplier or top line multiplier, not the net asset value. And we believe that we are very close to the moment when some of the stores will be ready for being franchised. So automatically we free up some of the cash capital involved in those stores, and that will also give us some bread for further investments and further expansion.
Okay, thank you. I think this is a question that either of you could probably take. So what is the competition pizza offer? What is the opposition offering up currently?
As far as our menu prices, we try to be a little bit behind Pizza Hut. As far as our discounting offers, it changes. There's different discounting in the market all over the place. So hard one to answer, but similar prices. It's not like we're not overpriced.
Okay. And again, question for you, Nils, here. Is the Croatia market profitable for you?
The stores are definitely profitable. We still obviously have an office which we run. So our 5th store opens in a couple of weeks, and we opened our 4th store over summer. That was 2 months ago. So with the 4th store, we should be cash flow positive, yes, and definitely with the 5th.
Okay, thank you. Edward, a question for you here. What percentage of the takeout market is pizza in Poland?
Takeout market? You mean the carry out, yes?
Yeah, carry out or delivery, I think, and probably including them both.
Okay, so I'm not sure whether I'm able to answer this question so quickly. I will give you a bit of the perspective to Polish market. It is valued at 1.3 billion pounds at this stage. This is more or less the value of the turnover that Domino's Pizza in UK is doing just by themselves. So we are less developed definitely than UK, and this is one potential. The second thing is that the market is chained in 20%, so 80% is independent players having small number of pizzas of stores. And definitely, if we look into the business, I would say that this is right now more dining and delivery oriented business. Carry out is not so well developed and so popular. Delivery got a boost in the development after the COVID times. We were first, so for us it was much easier to hold this dominant position in the pizza sector. And carry out is also something that we already had on board. So we are right now focusing on this channel, giving this advantage ourselves over the rest, that we do not add the cost of delivery to the consumers. And we also see that this is a competitive advantage. The market has not followed this direction yet so strongly. So we want to stay in this position for a longer.
Okay, thank you. A question for you, Nils. It's a tricky one, I'm afraid, but hello. It says, why do you think the share price has not reflected the success of the last 12 months?
Very simple. It's not floating. It's like a couple of months ago, we were discussing the same, and we saw some ups and downs. So investments and the investments on the market. Whenever we talk now, and we know a couple of people that wanted to buy the shares, and there is nothing to buy, more or less. That's the question. Why this is undervalued? Because this does not reflect the tendency and trajectory of the EBITDA. And from that perspective, having in mind who is right now on board and in which direction we are going, I'm pretty sure that this business has a potential to be successful in the near future.
Yeah, we were certainly tracking nicely. You know, we were heading towards the 10p, and then over summer when there was just lack of liquidity, there was retail selling, and it just affected us. So.
Yeah. Okay, thank you. Another question for you here, Nils. Are the delivery drivers employed by DP Poland? And with pressures to deliver more quickly, what are the dangers to the drivers with accidents, etc.?
Okay, so yes, we employ all of our delivery drivers, and yes, the emphasis on speed is definitely not on the road. So, you know, the biggest thing for Domino's is the speed is in the store, not on the road. You know, obviously we have all over the world, you know, thousands and thousands and thousands of delivery drivers. So, and the accident rate for Domino's is negligible. So, you know, as a company, we do a lot of work for driver safety. And that is our motto. So there is, you know, that's what it's all about. The speed is in the store. So where we save the minutes, it's not the drivers going faster. You know, we made our delivery areas smaller. We only send single runs rather than double runs. And then the speed is all in the store. It's how fast you get the order made and into the oven. And then when it's sitting outside of the oven, how long is it sitting there for before your driver actually gets it to his scooter on the road? So yeah, the speed is definitely not on the road, and that's a big one for us. Absolutely.
Okay, I've got a question here about franchisee growth, which I'm going to ask in a slightly different way because I'm trying to understand it. Which I think that the question is really trying to ask: when you're growing through franchisees, what's the mix between companies? I guess what's the mix between franchisees buying a corporate store and those franchisees opening a new store?
It depends on the market and where they are. So for us, if we have franchisees in regional towns where we don't have a presence, then they'll be building new stores. If it's places in Warsaw or areas where we're dominant, then potentially we can sell down our own stores. So it really depends on where they are. I mean, the country should have 500 plus stores. So there is lots of available options for franchisees. If they'd like to pick up a business where they know the profits, then that's one thing. Obviously, when you open up a store, you know, that's where you can make more money out of goodwill because you don't know what sort of sales is going to open up at.
Okay, thank you. And a question here for you, Edward. Given that Germany has outsourced a lot of manufacturing to Poland, how sensitive is GDP in Poland to this German slowdown?
Again, a very good questions. I would answer it bit tricky. In 2008, we were the same to some extent dependent from the German economy in Poland, and Poland was green and Europe was red, more or less. Yes, so that shows clearly that definitely there is a relation and dependency of Polish economy to German economy, but this is not the only one and dominant factor. Many things happened over the last 10 years in Poland. I would say that the economical relation, like business relationships of Poland with the world has changed massively over this 10 years period. We see a lot of American companies coming to Poland, investing in kind of a, let's say, Silicon Valley or similar-ish, because of lots of technical universities in Poland with pretty high level of education. So it's big population of the engineers that can support those kind of companies. And from that perspective, whether we are dependent, yes, we are. Whether this is a crucial parameter, I wouldn't say that this is a dominant factor, although it's one of the visible ones.
Okay, thank you. And we got one last question for you, I think, Nils. How do you incentivize the individual stores?
How do we incentivize? With a big carrot. Look, you know, if you want to make things happen, incentives is the way to go. Monetary incentives is the way to go. So we create competition amongst our stores. People like to win, so that's the first thing. And people like to take home a little bit more pay packet. So, you know, and I suppose, you know, that's the way. You know, we can pay a salary, but if we pay a bonus on KPIs, that sort of gives us that that same sort of ownership as a franchisee has with their own stores. We need our store managers and our managers to care about our KPIs. They need to care about our delivery times. They need to care about what the pizza looks like. They need to care that the order is 100% right when it gets to the customer. So if you can incentivize that, that's how you get how you run good stores.
Thank you very much, Nils. Thank you very much, Edward. That brings us to the end of today's webinar with DP Poland. Just to mention to those attendees, as you exit, you'll come to a feedback survey. It'd be really appreciated if you could complete that survey before you go. Yeah, thanks again for attending. If you have any further questions, please send them through to info@yellowstoneadvisory.com. Thank you all.
Thanks, everybody.
Thank you very much for your attendance.